chapter 2. So we're going to continue with analyzing transactions. We're going to add debit and credit parts. So we look at those accounting practices using T accounts. So we're going to use debit and credit for each transaction. And again, how they affect accounts. Only 5 terms. So using T accounts, as you can see, this is a T. Helps us to analyze the transactions. Assets on the left, liabilities, owner's equity on the right. The left side of the T account, the left side is called the debit side. The right side is called the credit side. So a T account represents an account. So we use this to analyze transactions. Every account is going to have its own T account. So all you need to know is that the left side is the debit side, the right side is the credit side of any account. Assets will have normal balance on the debit side. Normal balance is the side that's increased. Assets are increased with a debit, decreased with a credit. Liabilities are increased with a credit and decreased with a debit. Owner's equity, again, increased with the credit and decreased with the debit. So now as we are analyzing, we always have to be in balance. And whenever there's a debit, there has to be a credit. So if there's a plus on the left for the debit, there's going to be plus on the right for the credit. If there's a minus on the left of the asset, that's a credit. On the right, a decrease would be a debit. So the normal balance, again, is the side that is increased. So assets have a normal debit balance, owner's equity, and liabilities have a normal credit balance. So there's the increases and decreases I was talking about. Sorry about the interruption. Okay. So as I said already, you will see any asset is increased with a debit and decreased with the credit. And again, it's opposite on the right side. So we're going to skip the work together. And on your own, we're going to go on to analyzing how transactions affect accounts. Received cash from owner as investment, $5,000. So you might recall we did this using pluses and minuses. But now we're going to use debits and credits. Asset, cash gets a plus 5,000. So you debit. Owner's equity, capital account gets 5,000. So you credit. There's a plus on the left, plus on the right. 2 accounts are impacted, and the equation is in balance. So if we go back to chapter 1, when we learned this in chapter 1, let's jump to this transaction. Before we added debits and credits, it looks something like this. Plus on the left, plus on the right. Now we're adding the debit and credit. So it's still a plus on both sides, but and we say debit cash and credit capital. We're using the language. So we have these accounts we're going to be using. In your textbook, there's a chart of accounts. If you go back to chapter 1, Kim Park has accounts in her business. And I'll get you a list of those accounts. I guess they're not in chapter 1, but again, we're going to be using accounts, the chart of accounts, Now, when you analyze transactions, the same 4 questions are used every time. These 4 questions: which accounts are affected? How is it classified? So cash and capital are affected. Cash is an asset. Capital is owner's equity. Assets increase. Owner's equity increases. So we debit the asset and we credit owner's equity. These 4 questions we are always going to use for analyzing. Paid cash for supplies, $275. So in chapter 1, it looked like this with the pluses and minuses, right? So paying cash for supplies, you did a minus to cash and plus to supplies. One asset decreased, one asset increased. But now we're adding debits and credits. So we debit supplies and we credit cash. Same 4 questions are being asked. Supplies and cash. Supplies is an asset. Cash is an asset. Supplies increased. Cash decreased. And we use the language. Debit supplies for $275, we increase, and credit cash for $275, decrease. Insurance, same thing. Plus $1,200 to insurance, minus $1,200 to cash. On the asset side, we debit insurance, we credit cash. Supplies on account. So again, we saw this transaction in chapter 1. Buying supplies on account. So we are buying on account, so we're going to gain debt. It's going to be a liability. So plus to supplies and plus to the liability. The left equals the right. And it's shown here. Supplies gets a debit, it's increase, plus 500, and owner's equity gets decreased by 500. So we debit supplies on the asset side, and we credit the accounts payable to show we have 500 plus on the left, plus on the right. And again, using that language. Paid cash on account. Again, if we go back to chapter 1, here's paid cash on account. Up here, minus 300 to cash, minus 300 to liability. Again, we are in balance, but now we're using debits and credits. So we have credit 300 to cash, debit 300 to liabilities, and minus to cash and minus to liabilities. And again, we analyze the transaction using the 4 questions. And it just continues. Cash from sales, same thing. You debit cash plus $295. You credit sales plus $295. Plus on the left, plus on the right. Again, using the debit and credit to show the increase and to show, again, increase on the right. So there's increase on the left and increase on the right. And then we have a sale again to Oakdale School. So both assets. So remember, sales recorded when it occurs. So the sale's happening right now on the 12th. So we're going to debit accounts receivable. The balance for Oakdale is increasing. So plus 350 on the left and then plus 350 on the right. You debit accounts receivable to show the increase. You credit owner's equity, the sales account. So now we have a sales account. So we credit for 350. Just like we did up here, we did a credit to sales and we did debit to cash. They're both sale transactions. And same 4 questions when we analyze this transaction. Expenses. Remember, expenses cause equity to decrease, but now expenses are going to have actual account titles. Cash for rent. So you're going to credit cash minus 300, minus on the left, then minus 2 owner's equity. So rent expense is going to have a debit because it's a minus. So minus 2 cash, minus, which is a debit, to the expense. So keep in mind that expenses will always have a debit balance because they always cause the equity to decrease. Owner's equity is decreased because we have expenses. So expense account is going to be used for things like rent and utilities So we're going to use separate expense accounts so we don't mix them up. And to avoid having everything going into capital, it will just get confusing. So that's why we have individual expense accounts. Now here's cash on account. So plus to cash, debit cash, minus to accounts receivable. So you credit accounts receivable, plus, and a minus on the asset side. So cash increase, so cash is debited. Accounts receivable is credited because its balance decreased. Again, same 4 questions. And here's owner taking money out for personal use. We learned that we have to keep it separate. So we're going to credit cash to show that money was taken out of $125. So minus to cash. So cash gets a credit of $125. And owner's equity gets a debit of $125 because it's decreasing. We credit on the left to show a decrease, and then on the right, we're going to have a debit to show that owner's equity decrease. And we use an account called Kim Park Drawing. Kim Park Drawing is the account we use when the owner takes out money for personal use. Cash went down, and owner's equity went down, a minus on the left and a minus on the right. So I know this might be confusing because you see the arrow pointing up. All that's showing is that withdrawals went up. So when Kim Park took money out, that was a withdrawal. But our equity decreased because Kim Park took money out. So drawing is debited to show the decrease. And that's the end of the chapter. Review and read over all the details. We'll do the problems in each section later.